It's a new week. Let's start Monday with some moderately good news for what lies ahead.
Once we get past a lot of this purple haze of policy uncertainty, 2026 is shaping up to be an acceleration type of a year. By the way, I mean, from an earnings growth perspective, 25 at the rate it's going is also an accelerating growth year. I think there's just still some questions about the trajectory of economic growth.
That's Amanda Agati, Chief Investment Officer at PNC Asset Management Group. And she does think as we finish off this crazy train of a year and get through the purple haze she mentioned, this market and economy can rock on. But up first today, Ted Rossman, Senior Industry Analyst at Bankrate.com, looks at back-to-school shopping trends, which are surprisingly good in an environment where people are complaining about high inflation. Plus, David Traynor, founder and president at New Constructs, puts a financial services firm in the danger zone, saying their funds might not be good for your wealth, but their stock's a problem, too.
Let's boogie!
Welcome to the Boogie Down. Let's rock this joint indeed, because this is Money Life for August the 11th. And yes, Amanda Agati does drop a bunch of rock and roll references. It's part of the fun of getting a chance to chat with her. And it's a very fun, big interview with pretty good news. Although, I want you to definitely pay attention. There's a point in this interview where she talks about how she thinks that there will be much more market breadth, but then later she explains that to her, market breadth is really the S&P 493 after the Mag 7 and not small caps. That's an important thing, because when we hear market breadth, how far is somebody willing to go and what do they want to do determines a lot about their portfolio. And she makes a point about breadth, but she also talks about places she's not going. So that is one that you should have some fun with. She also refers to some stuff on back to school shopping, and Ted Rossman will kick us off today talking about it. And there's actually some good news there. And of course, David Traynor, always great to catch up with him. And we've got a market that, well, it's going to be really interesting to watch. We are in the summer doldrums, but we're through the bulk of earnings season. So that's important. We still have earnings to go, but a lot of it has been done now. And so, we're always talking about those things. What we don't always talk about is your financial life in other ways. And I want to talk about something that I spent part of, realistically, the weekend pursuing. Because Gail and I had a really nice weekend, but one of the things that has happened is that I needed to replace my office chair. If you see the videos that we're posting on LinkedIn, on our Facebook page, on X, on Blue Sky, on Instagram, all the places that we put those things, you might notice that my chair is a little bit lopsided. And I have a tendency to basically break my office chair pretty much every 2 years. It has been a consistent thing with me for years. I've tried a bunch of different chairs. The fact is, I live in my office and I'm dropping a big body into that chair all the time. And so at some point it's going to break. So there was a piece of my chair that broke and I knew, okay, I'm going to have to replace this. I hate this. Gail said, how long has it been? And when I went to see when I had purchased my chair, well, it had been 2 years. But what I noticed that I had forgotten about, completely forgotten about, was that I had purchased a warranty protection on this chair. Now, I'd forgotten about it because I don't, as a general rule, buy warranties on anything. Insurance is to pay for what you can't afford to lose. I find that a lot of those warranty policies are really tricky to get to use. I often find that it's just a waste of money. So as a general rule, I'm not a big fan of policies that wind up saying, okay, I'll purchase a warranty, et cetera, because how much is it going to save you? As soon as I saw it, I'm like, oh, that's right. Gail had convinced me. We'd been together for, 4 years and I'd gone through 2 chairs or what have you. She's like, why don't you buy the warranty? It'll help you. So I bought the warranty for 3 years on the purchase of my chair. So now we had to go and pursue this warranty. So we went through and figured out what the claims process was. Had to have pictures of the damage. Sure, no problem. Had to have a receipt. Not a problem. Available through the store that we had purchased it from. Had to fill out an insurance claim form. Well, we put in everything that they told us to put in. They said, you don't have a claim form. We filled out the claim form. And it was starting to feel like maybe this is going to be a runaround. And then they sent us back a note that said, your claim has been denied. But they didn't tell us why. So we're going, why would our claim be denied? Called up, found out that the claim was denied because when we started to process the claim, Gail had called and she had given them her phone number, or they had said, is this an acceptable number? She said yes. But when I had filled out the paperwork, I had given them my phone number. And because the phone numbers did not match, they're like, oh, we can't process this claim. They closed out the claim, having canceled it, having said, we're not going to process this. So when we called back, they're like, nope, you got to start again. And I'm like, oh, is this that thing where you're going, I bought this and you're making it impossible for me to use? We had problems, by the way. We had called. It had taken some time. We'd called. They said, we'll send you an email. And I wasn't getting their emails. I have a special email address that I use for issues like this, et cetera, and some of the online stuff I'll do as well. And I wasn't getting their emails. Couldn't explain it, had called multiple times. So by now it's starting to feel like, oh, this is going to be that warranty ripoff that I worry about. But once they had everything and they had it right, they were like, let us process. Yep, absolutely. Your chair is damaged. Boom. We are sending you an e-gift card to the store that you bought the chair at, et cetera. They wanted to help me shop for the next chair. I dealt with a man, I want to say his name was Paul, and the company is Assurion. It could not have worked out better, to the point where when I bought the new chair, so they gave me a credit for the cost of my last chair. The chair is a little bit more expensive now. It is, of course, 2 years later. But the insurance is the same price. So I decided to buy the insurance again because I literally go through a chair every 2 years. And this saved me a significant chunk of money. Obviously I spent $60 or whatever it was for the warranty. I got over $200 for the value of my chair. That's a good purchase. And it's not that I can't afford to buy the next chair. It's that I, in this case, pretty much have a track record that says 100% I will wind up using that insurance. And that's part of what I think, because I am distinctly not that guy. And although the experience was frustrating in the beginning, in the end, it could not have turned out better. So I'm not saying that your experience, if you deal with Assurion, which does a lot of different things, you could go into a bunch of different stores and they say, hey, we have a buyer purchase protection plan. Assurion is one of the companies that does that. It could be them for a lot of things. I'm not saying your experience will be the same. And yes, you're going to want to make sure your I's are dotted and your T's are crossed. And you're going to want to follow up if they say your claim is not good and you believe it is still good. But at the same time, I found it worthwhile. And I can honestly say it's almost surprising. And thank goodness I didn't forget, because it would have been a complete waste. So if you're going to ever do it, make sure you have some way to remind yourself that you've got it and pursue it. And yes, I just bought a new chair. It'll arrive this week. And I suspect that 2 years from now, I will be doing the exact same thing again. Maybe you'll still be listening to me then and you'll find it. But right now, you don't have to wait 2 years for anything else. We've got a great show to get to. Remember, write me, chuck@moneylifeshow.com. What's your experience been with warranty programs? Are you surprised that it worked out for me, or do you do this all the time and it pays off for you? I'd love to know. But right now, you'd love to hear from our guests. So let's go. Ted Rossman, David Traynor, Amanda Agati. The talk starts when we come back next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Now let's take a look at what the survey said. Welcome to The Survey Said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are digging into the back to school survey from bankrate.com, something they do every year. But this year, I would say that the numbers are a little bit surprising. I'm glad that they are. You'll understand why in just a second. But here to discuss it is Ted Rossman, Senior Industry Analyst at Bankrate. And if you find him on our guest page at moneylifeshow.com, or if you see where he's mentioned in our show notes, you will find the direct link to bankrate.com that gets you to the back to school survey. Ted Rossman, great to have you back on Money Life.
Great to be here. Thank you.
Like I said, I was a little bit surprised by some of this, not from the standpoint that, the obvious thing that we figured would be, inflation, people are paying more and it's hurting them and they're complaining. But the answer is that, yes, inflation is changing the way people shop, but maybe it's changing that for the better. Even though it's putting pressure, back to school shoppers are doing better things for their money this year, apparently, right?
Yeah, I was pleasantly surprised as well. We found that 30% of back to school shoppers say that inflation is changing the way they shop this year. That's down a little bit from 32% last year, but it's down a lot from 41% in 2022. That was the year that inflation peaked, of course. We've seen such downbeat consumer sentiment numbers of late from the University of Michigan and the Conference Board and others. I actually take this back to school data as a read that things may be improving a bit. Another silver lining is that we're not seeing the kind of tariff impacts that we had feared. Prices have actually been very stable on back to school items. They've actually fallen a little bit in some of the key categories like clothing and computers. Those are both down a little bit year over year. The National Retail Federation says that the average kindergarten through 12th grade back to school shopper is spending about $20 less this year than last. The average is still a hefty $858, but at least things are not getting worse. They're even getting a little bit better. People feel like their dollar is stretching a little further this year, which is good news.
Yeah, we are always talking about how folks feel stretched, but they don't necessarily do anything about it. They're worried, and then we say, "But are you changing your habits?" And they're like, "No." But here, like almost half of the people that are back to school shoppers said they are trying to do something about it this year. I thought that was kind of stunning.
Yeah, 49% of back to school shoppers are employing one or more money saving strategies. The most common are buying cheaper brands than usual and seeking more deals and coupons than in the past. 20% said each of those answers. Also a little bit surprising just because we've been dealing with higher prices for years. One of the frustrations I hear from consumers is they feel like some of the low-hanging fruit is gone. Like maybe they've already traded down to cheaper brands or they've already sought more deals and coupons and other discounting strategies. So many people, especially those with lower incomes, are saying, well, what else am I supposed to do? I've already cut back. I've already tried to be creative. I do think that some of this is that there is maybe still some room for improvement. I like the idea of stacking discounts. That's one thing that I do think more people could take advantage of. And you can apply this to other forms of retail too. It's not just back to school. You could do this for Christmas shopping or even everyday shopping. Combine that store promo with a rewards credit card that you hopefully pay off before interest hits. Use a card-linked offer, one of those Amex offers or Chase offers or one of those digital coupons. Go through an online shopping portal like Rakuten. You could potentially combine 4 saving strategies, maybe even more, on the same purchase. But those are 4 right there.
I love that advice, especially for anybody who's struggling, but also just because there are steps that you can take that are not exceptionally hard. I mean, going through a shopping portal that's really what you're doing when you go to Amazon. Amazon's basically a shopping portal, but you're using one that is maybe a little more consumer friendly or a little more budget conscious as you're doing some of it at times. So, do that shopping around. I did find it unusual that people say they are buying cheaper brands than usual because in back to school shopping, I can't say that my kids had to have Dixon Ticonderoga pencils versus some other brand. I can't really remember any other brand of pencil in my head. It's been a long time since I was in school or buying stuff for my kids in school. But kids tend to be so brand conscious. I would think sometimes that one's tough. So was there any indication of what they're going for the cheaper brands on? Like, are they going for cheaper brands on the back to school clothing, which can sometimes be tough? Or are they going to cheaper brands on I don't care what your notebook paper is?
We didn't get too specific on that, but I do think there's a good lesson in here about involving your kids in the process. I should note that National Retail Federation number, that $858, that does sound high. That's including electronics, clothes, backpacks, shoes, and school supplies. So it's not like you're spending $800 on just pencils and notebook paper. Just wanted to point that out. But I think it also relates to your question that if your kid wants to splurge on a fancy outfit or backpack or shoes, or maybe it's even the folders with the cartoon characters on them or the pens that have their favorite movie character on them. I mean, whatever the splurge is, that's okay if they're willing to cut back somewhere else. That's where I say involve your kids in the process. Talk to them about the budget, help educate them about being a savvy shopper. You could talk about things like unit pricing. You could talk about making trade-offs, like if you spend more in one area, you've got to cut back in the other. Sometimes back to school shopping turns into a fight in the aisle about, I want this, I want that. Involve your kids, work with them on a compromise. Financial literacy is often undertaught in schools and at home. I view back to school shopping as an opportunity to work together on that.
I agree completely. The more your kids grow, the older that they get, the more you can have them do, to where, what I actually wound up doing was having my kids at a certain point basically have a shopping list and a budget, and basically say, look, here's the money I'm planning to spend on you for your back to school stuff. This is what you need to buy. But, oh, by the way, anything that you don't spend, you can use on extra clothes, you can use on what have you. So if you really want that fancy pair of jeans or whatever it might be, figure out where else you can economize. And it really taught my kids important lessons that now that they're in their 30s, they use all the time.
I totally agree. Yeah, it's really important to be a savvy shopper. These are lifelong lessons that you can apply at the grocery store and when making other retail purchases. A lot of it comes down to comparison shopping, making a list, making a budget, sticking to it. There are a lot of sales out there. We've been pleasantly surprised on the tariff front that a lot of retailers have actually absorbed the higher prices. Now, it remains to be seen if that will last, and some of these tariffs have been delayed or rolled back. The season started earlier than ever, by the way. The National Retail Federation said about 2/3 of back-to-school shoppers began as of early July, which was a record high. Some of that's driven by Prime Day and other early events. Some of it is an effort to spread out your cash flow. I expect we're going to see the same thing around Christmas time. In recent years, Christmas shopping has started for many people in early October, or sometimes even earlier than that. I do expect this will be another year when the deals roll out early. And I actually think we can use that to our advantage as consumers. I know sometimes people scoff at the season creep, but then again, it does give you more time to spread out your cash flow. So that's another shopping strategy.
Yeah. And it does help if you're going to do those other shopping strategies, shop around a little bit more, all those other things that we said folks are doing. And folks seem to be getting it. So we'll take it. I mean, again, the numbers don't say massive changes, but I like a study that says we're not all just falling on ourselves because, prices are up or what have you. So good news, Ted. Great to get it from you. Thanks for joining me on the show.
A little optimism is a good thing. Yeah, thanks for having me.
Ted Rossman is Senior Industry Analyst at Bankrate.com. That's where you're going, not only for information on the survey, but if you want to find out about all kinds of bank rates that affect your finances, they've got all the tools you need. We have a direct link to their back-to-school survey in our show notes and on our guest page. And speaking of going back to something, well, we'll take a quick break, and then we'll be back to more of Money Life in just a moment. If you're looking for trouble, you're in the right place. Belly up to the baddest biker bar in the investment world. You're in the Danger Zone. Welcome to the Danger Zone on Money Life. This is where we get the latest take from the experts at New Constructs, where they evaluate securities on a scale of most attractive to most dangerous. They do it by bringing together discounted cash flow analysis and forensic accounting, digging in at the footnotes level and working their way up. What they find is that when you get past skin deep, you often find that things are misleading. And if they're misleading and they would work against you, that makes them dangerous. Learn more about how it works by going to newconstructs.com. David Traynor is founder and president at New Constructs. David, great to chat with you again.
It is good to be with you, Chuck. Thank you.
Who's in the danger zone this week?
Mediocre asset managers and ETFs.
Danger, danger.
Mediocre asset managers and ETFs. I am absolutely certain there is a story behind this. The fact is there are plenty of mediocre funds and ETFs. So what is the specific way we're identifying them as mediocre, and what is it that they are doing that is inherently dangerous?
Yeah, Chuck, this is sort of a big picture and small picture. So, what we're talking about is what we talk about when we analyze all ETFs and mutual funds. We're looking at the quality of stocks that the fund or ETF holds, and using the same lens we use to identify danger zone stocks and very attractive stocks. And then we decided to sort of look at them across at the asset manager level. And what we identified was both a stock that is for an asset manager that sells a disproportionately large number of unattractive funds and small number of attractive funds. And so, what we're talking about here on the second level is that investors really don't have to pay fund managers at all if they don't want to. And when you boil it down, what fund managers do these days is bundle stocks for people. That's all they're doing. They don't do a good job of it. Most of them underperform, especially, the company we're going to talk about here in a second. So why are we paying fees at all? Why are we paying fees? Because really, if they're going to put together a group of stocks and it doesn't outperform and they're going to charge me a fee, I'm sort of losing double. I'm paying fees and I'm underperforming. I'm probably underperforming worse because of the fees, but you know what I mean. So where's the value add? We believe people should be able to, there should be, just like Home Depot has do-it-yourself for home remodeling, there should be do-it-yourself for building your fund. Not only can you pick your own stocks, but you can weight them on better metrics. And we now have proof that weighting stocks based on better metrics outperforms. Proof in the form of our indices. Our index that weights the S&P stocks based on core earnings outperforms the S&P. And then if you pick stocks based on core earnings, that also outperforms the S&P. So you can pick stocks better based on better criteria, weight them based on better criteria, and outperform. What we're saying is just build your own ETF. And there are simple tools that we offer and other people offer to do that. And that's the way to go.
Well, and these days when you can do things commission free and what have you, it's not hard to build a portfolio. You might not want to do an S&P 500 and try to manage 500 stocks, but you might want to do something that is a little more distilled, et cetera. And still, you can find indexes that have 25, 30, 50 stocks, whatever it might be, if you wanted to do it that way. So that's one side of it. But as you pointed out, if you do it badly and it's your business model, somebody else is paying the price. So who is it that you've been hinting at that should also be identified as being in the danger zone this week?
Virtus Investment Partners.
Danger.
So Virtus Investment Partners, that's ticker symbol VRTS. Why specifically them?
Because the stock looks bad. It's unattractive stock, and they have a bunch of unattractive funds. It's unattractive all the way across. So, we look at some of the other big asset managers. When you look at comparing to Franklin Resources, Invesco, BlackRock, the percentage of unattractive or very unattractive funds offered by Franklin Resources is 28%. Invesco, 32%. BlackRock, 27%. At Virtus, it's 45%. So almost double what these other guys have in terms of unattractive. And then on the attractive side, Virtus only has 9% of their funds get attractive or better rating, and Franklin, Invesco, and BlackRock are all 20% or above. It's kind of a double whammy, right? The stock itself is unattractive, and then they're putting out there a lot of unattractive rated funds. And look, these people are charging fees to put together stocks. And what I liked about what you just said, Chuck, is there are no transaction costs anymore. Let me take a step back. In the beginning, you had to buy a mutual fund if you were a small investor, if you wanted to have a diversified portfolio. You just couldn't do it. And so they had you because, number one, you couldn't buy fractional shares. And that meant you were going to be forced to buy stocks in 100 share lots. Back in the day, you couldn't buy a single stock. You couldn't buy a fractional share. You had to buy at least 100. And then there were transaction costs on top of that were really high. So most people were just completely and utterly priced out of being able to pick stocks on their own. Now, all those things have gone away. Even better, what's gone away is access to good research. It's not just all Wall Street research. There's independent research out there. So, like with our system, for example, you type in $5,000, you pick 60 stocks. and you choose your weighting methodology, and it pops out an order form with fractional shares that divides that 10,000 bucks among 60 stocks, and it's boom, go. It's that easy. You've picked the stocks, you've chosen the weighting methodology, you have a portfolio that's designed on your own, just as good or better than what you could get from anybody else.
And again, if you don't want to go to that effort, it's not that you will pay zero to own an index fund, but the basic index funds in ETF form, the costs are de minimis. They are, a handful of basis points for, a core get me the index kind of portfolio. So functionally, that's the competitive point that you're going to have to tell me that it's worth it to pay for active management. And what you're saying is that frequently it's not just because they're not managing well, but because they're putting a lot of money in dangerous stocks.
Yes. And the passive funds are cheap. They don't always perform that well. So what we're saying is, like, people deserve to have their cake and eat it too, right? Don't pay any fees and maybe get better performance than a passive fund.
Let's talk a little bit more about Virtus Investment Partners. It's trading at like 185, 190 bucks a share. And so what you're saying is the stock is bad, their funds are bad. What is an appropriate value for a bad fund company?
So as I mentioned, this stock gets our unattractive rating. And when we do the diligence on the economic book value or no growth value of the business, it's negative 25 bucks a share. And so we're seeing, a really pretty highly overvalued company here. Return on invested capital is just 4%. It's not making money. We also see a large amount of debt, 2.3 billion on a market cap of 1.3 billion.
When you talked earlier about asset managers who are in good shape, and you mentioned Invesco and BlackRock and Franklin, do you find a general correlation? Like, I understand we could look at those companies and find bad funds, but do you find in general a correlation between a good fund manager versus a bad fund manager and the values of the stocks? Like, are you more likely to like the stocks and find that the BlackRocks, the Invescos, the Franklins, all publicly traded companies are better stocks to own than Virtus, and also their funds are better funds to own than Virtus? Or is that too much of a statement to make?
Not quite, Chuck. I'd love that to be the case, but that is not quite the case. BlackRock, Invesco, and Franklin Resources, none of those guys get an attractive or very attractive rating. These fund companies tend to be so big, and there's, I think, a desire to populate as many shelves as possible in terms of options, and I've seen this with partners we have in the space ourselves when we talk about our indexes. There's a lot of noise, and there's just a lot of stuff they got to have on the shelf. I mean, just like when you go to the grocery store, there's a whole bunch of stuff you'd never buy, but you might still really like the grocery store because they got to serve a wider audience. And there's, unfortunately, I think, still a great deal of folks who don't know you, who haven't followed your show, who don't have the sophistication to know that there are a lot of really, really bad funds out there that people put money into. We use our fund screener. I'm still floored to see funds that are charging total annual costs of 3, 4, 5, 6, 7%, and there's money in them. I'm like, who are these poor souls? And I haven't seen in general, like even among the smaller asset managers, people who do it really, really well. And I think if you're that good, you're in a hedge fund. You're not a mutual fund complex. You don't really want that regulation. You're not really catering to the broader public who isn't necessarily sophisticated enough to appreciate what it is you're doing. And so that's where you're going to find that most of the time.
And you're not saying that all active management is terrible, but you are saying the need to be hyper selective shows itself in all those statistics that get thrown out about how few active managers beat indexes.
Yes. Yeah. I mean, Chuck, hyper selective, diligent, discerning. Don't we need to be that way in everything we do? Aren't we all better served if we do that? If the fund business is no different.
That is why Virtus Investment Partners, but also investors who are investing in mediocre, actively managed funds, are in the danger zone this week. David, great stuff as always. See you again next week.
See you next week, Chuck. Thank you.
David Traynor is founder and president at New Constructs. Go to newconstructs.com to learn more about how they do their research, to see their lists of most attractive and most dangerous stocks, and much more. And we will be back on Money Life. Up next, the big interview. Amanda Agati will be here. She is with PNC Asset Management. We'll be talking big picture when Money Life continues right after this message.
Oh, wow. This is actually pretty dangerous.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Welcome back to Money Life, where it's time for the big interview on the August 11th show. Joining me now, Amanda Agati. She is Chief Investment Officer at PNC Asset Management Group. If you want to learn more, you're going to go to pnc.com. But if you really want to learn more, you're just going to stay right here. As I say, Amanda Agati, it's great to have you back on Money Life.
It's great to be here. Thanks so much for having me.
This has been a market that, it's kind of living up to the adage that years are short, days are long. Like, the days, what's the headline? What's the worry? What's the concern? People are miserable, etc. But the year, we got to August, which can sometimes be seasonally tough, but it's been a pretty good year if you just kind of ignore all of the day-to-day stuff. So for you right now, can the positives that we've had at this point continue, or have we had enough of that and all these worries that people have said they got to come to roost at some point?
Well, there's no question it's been a crazy train kind of a year. Hopefully you caught that Aussie reference, RIP. But that's sort of, from my perspective, the best way to describe the year that we have had in the last kind of 7+ months, right? I'm totally with you that we've lived many lives here on a year-to-date basis. There's been some really positive things that I think have transpired. Obviously, the market has had a record breaking kind of V-shaped recovery here. But I think it's less about the move in the market itself and more about a function of some of the still very strong underlying or hard data that in the first part of the year, I think was very much underappreciated because I'll give you another musical reference, in the purple haze of fiscal policy uncertainty, that's really the only thing that mattered. Nothing else matters. That's a Metallica reference for you. I'm on a roll today with my song references. But in the beginning of the year, the only thing the market could focus on was the unbelievable fiscal policy uncertainty and the purple haze. And so it was losing track of what I think were some very strong underlying fundamentals in terms of both economic growth and earnings growth. We started off the year in a good place and then sort of the wheels came off. So where are we at this juncture? I mean, I think the pace of advancement into the end of the year has to naturally slow down, right? Just for everything that we've been through, we're back to effectively all-time highs. We're back to a P multiple that's in excess of 22 times on the S&P 500. So it doesn't leave a ton of room for a bull market advancement from here. It doesn't mean that we finish the year in negative return territory. I mean, I think we can claw our way to a few more percentage points of gains, but I think it's going to be much more of a 2 steps forward, 1 step back, kind of a slower grind into the end of the year. Because as you said earlier, and I will reiterate, some of the big things are going to start to come home to roost in the second half here, namely the effects of tariffs and trade related policy that have finally, as of August 1st, started to come to fruition. We've been wringing our hands about them the last couple of quarters, and now it's real. And so what happens with that in terms of the dynamic around inflation and how fast it puts the brakes on economic growth are key wildcards to the market's path forward.
Are you worried that the fact that inflation did not show up as we might have expected it to, given all the tariffs, now that we're starting to see it in earnest, that it's going to show up that much harder, if only because while there was the uncertainty, companies were doing what they could to maybe not pass along the price. Nobody wanted to be the first actor on inflation's hurting me, let me pass along 100% of what I think the price increases will be. But now that you know what they're going to be, do you worry that it's not just that tariff-related inflation is coming, but it's coming particularly hard to pay back for the fact that it hasn't been here yet?
I'm less worried about the rate of change on inflation than I am what happens to economic growth. I don't know that this catalyzes a true second wave of inflation. It's going to be a step change higher, certainly, as it relates to the expenses and higher costs associated with tariffs. But this doesn't carry on into infinity, right? And also, when we think about where tariffs on sort of a weighted average basis are landing, sort of in the 13, 14, 15% range. So the days of thinking it's 30, 40, 50, 80%, right? The worst, by far the worst case scenarios that we were worrying about earlier in the year, we now have kind of a range bound, high and a low bound in terms of expectation. So from that perspective, I think it can be manageable. It's not ideal. I'm not convinced that this is a positive move in the market's eyes at all. We tend to prefer free markets and free trade. And so, I don't love the idea of seeing these tariffs go into effect, but I think given how strong earnings growth has been for the market on a year to date basis, the breadth of advancement in terms of earnings growth. So it's not just about the Magnificent Seven, and the idea that we have seen profit margins expand in the first half. It does give corporations a little bit of room that they didn't have at the beginning of the year to deal with some of this tariff impact and higher input cost impact. It doesn't mean that they're going to eat the whole thing, but I also think it doesn't mean that they're going to pass through all of it directly to consumers. I think there's potentially a middle ground to work through. So I think it's manageable from a trajectory or rate of inflation standpoint going forward. But I do worry about whether this puts the brakes very hard on economic growth in the second half. I mean, the last GDP report came in very strong, much better than expected. A three handle on GDP growth for the US. It's hard to argue with that, right? But what does the path forward hold? Does it create, again, a bit of a crisis of confidence, not as severe as what we saw in the first half, but in the second half, that actually leads to behavior changes? We haven't seen consumer spending, consumer behavior slow down, but we put the consumer through the ringer. And so I think that's the bigger worry for me, is just, do we finally say that's enough? And it's a more abrupt slowdown than what I think market participants are expecting.
Obviously, you've been paying attention to the soft data, the stuff where it says everybody is miserable, everybody has indigestion, even as their portfolios have reached record personal levels and the market has gotten back to record highs. Consumers have a long track record of going, everything sucks while I spend all my money. So I don't know that that's ending. But if we don't get some sort of a change, does there come a point where you just kind of pretty much factor out the soft data and just go, people are always going to be bitchy about this stuff, I'm not going to pay attention anymore?
I would love to say I'm gonna throw out all soft data, survey data, but I don't think that's realistic. I think, you have to be very careful about how the surveys are constructed and created, the pools of individuals that are actually being surveyed, to kind of get an understanding of what we're being informed on. And so I don't know that there's a perfect or precise survey that necessarily tells us the full story of what a US consumer on balance is dealing with. So I always try and pay attention to what the surveys are saying, but you're absolutely right. We've been powering through for a number of years now from a consumer spending behavior. And even when we shorten up our line of sight and look at weekly retail sales data like Johnson Redbook data to try and inform, is there going to be a little bit of a shift in trend? We just aren't seeing it. And so I also think it's sort of funny that we're talking about, they may complain, right, about their stance on things, but that doesn't stop them from spending. I always tease that, like, a Gucci bag makes me feel better. So, if I'm really disappointed or I'm really depressed, like, going out and shopping does make a difference. Do I think the average consumer is is buying Gucci bags. No, I'm just sort of being a little bit facetious about it. But I think there is something to be said for this continuation of spending. We've seen a shift certainly from things, stuff and things, technical terms for you, to services and experiences. So we've already seen that kind of shift post pandemic. I think there's a lot less big ticket purchases today than we've seen in the last few years as well. So there's shifting and preferences that are happening around consumer spending, but we're still in the mode of spending. And when you look at household debt relative to income levels, it's actually in really positive shape. We don't see consumers on balance. Again, the lower end consumer is a different story. They're very much under pressure, but on balance, we don't see consumers as over leveraged as maybe they would have been in the late innings of prior cycles. So, from that perspective, I think the consumer health backdrop is pretty good. And I think key questions for us going forward are, what happens with back to school shopping? That's going to sit right in front of us here, if not already. What does that activity look like? And of course, the holiday shopping season. But we're not seeing any material data points that confirm a material shift in trend around consumer behavior. I think you just have to be honest and say that the consumer's been through the ringer these last 5 years, right? Since the onset of the pandemic. So at some point they have to exhaust themselves, but we don't think it's yet. We don't think it's a 25 phenomenon.
Well, it's interesting because we started this show with an interview with Ted Rossman from Bankrate.com looking at back to school spending. And there have been some mild changes that show up, though they suggest that consumers are just being smarter and not necessarily doing everything else. So we'll see. And as for surveys and the reliability of survey data, I actually like taking surveys from the standpoint of I, as a journalist, want to know the questions that are being asked to go through the experience. But I also consider it kind of like jury duty. I'm not sure I want to be judged by the people who can't get away from the surveys, any more than I want to be judged by the people who couldn't get out of jury duty. So sometimes I think that may be part of the issue here.
Absolutely. Yeah.
Let's move this to where you think we're going to wind up seeing the best conditions. Because, of course, we've had the domestic market has done well, but international markets have done better. While international markets have been doing better, they've now created sort of two schools of thought. One is they've got better valuations that can continue, stay riding hard on the international stuff because here's where diversification pays off. And the other is that rally that you've seen, that's it. We pretty much have seen that period where diversification pays off and the international stuff is there. So are you in the keep going on the international side, it's going to be well, or not so much?
I think it's going to be a little bit bifurcated. So, as it relates to developed international, I think unfortunately that pendulum is going to swing back in the opposite direction. If you look at performance on a year to date basis, a big chunk of it has come from currency movements. US dollar's obviously been pretty weak over this period of time. So, it's less about returns being driven by underlying fundamental strength and a real material expansion in earnings growth, and a little bit more about currency and policy and interest rate differentials. And so I do think a lot of those variables are set to kind of shift in the opposite direction and become headwinds for developed international in the second half. So we are tactically underweight developed international equities. As it relates to emerging markets, I think the story there is very different. I think there's a ton of opportunity from a valuation, relative valuation perspective there that's cheap, very, very cheap on a relative basis versus the developed world and certainly versus US developed, right? So I think there's a decent amount of opportunity in emerging markets. I think you have to pick your spots very carefully, but I think in an environment where growth is slowing around the globe, investors will continue to pay up for growthier types of exposures. And there's a ton of opportunity, I think, in emerging markets. Even if you just look at technology, innovation, and the growth side of the equation there, I think that's a story that's going to reassert itself in the second half of the year. Is it going to beat US markets? I'm not convinced of that. But I do think that there is certainly some diversification benefit to be had for multi asset investors to have exposure to emerging markets. I would not be passively buying an EM index, though. I think in this environment and given the complexity of policy rates and currency movements, all that sort of thing, active management is going to rule the day. That hasn't always been the case, but we do think active management reasserts itself. It already has to some degree this year, but I think it's an even more important story in the second half.
And given that, and that active management can rule the day, and given that you think that the second half of the year or what's left of it will be maybe a little more muted than the first, there is a school of thought from a lot of folks that goes, you're clipping a nice coupon on fixed income if you're worried. So, maybe you go in that direction. So where are you in terms of weighting? I mean, how much are you overweight or underweight the equity side, domestic and international, given that you can clip a nice coupon?
We're just ever so slightly overweight, maybe 5% or so tactically overweight our strategic benchmarks in equities versus fixed income. And that's really just because I think we're believers in once we get past a lot of this purple haze of policy uncertainty, 2026 is shaping up to be an acceleration type of a year. By the way, I mean from an earnings growth perspective, 25 at the rate it's going is also an accelerating growth year. I think there's just still some questions about the trajectory of economic growth, but to the extent that we get a reacceleration, maybe even sort of a mid-cycle reacceleration, right? I said earlier late innings, but we have the ability here potentially if we can get past some of this purple haze to create a reacceleration in economic growth into 26. I don't want to be short. I don't want to be underweight equities in an environment where that's possibly the case. And so that's where we are from a positioning standpoint. It doesn't mean that we don't like fixed income. I actually think where rates have been, where bond market volatility has been, it's actually been a much more attractive place to allocate capital than it has been in the last few years. And so we're not, negative on fixed income. We're just believers in the growth story reasserting itself. And so that's kind of the dynamic at play there. I think the other thing, which we didn't really talk about yet, and maybe you were headed there, is the role of alternatives. So thinking about the public equity versus public fixed income versus private market split is also a very important one for investors, especially when valuations are as lofty as they are in the public markets.
And do I take it from that as much as you just said you're not sour on fixed income, you are sweeter on private equity and private credit?
Yes, I would say that's the case on a relative basis. Again, I'm not feeling overly negative or bearish on fixed income. There is a stability there, and with where rates have moved to, it's a much more attractive place to allocate capital than it has been, particularly since the Fed has kept rates higher than maybe most would like for longer. I think there's certainly a bias towards cutting from here, but we're not looking at zero interest rate policy, right? We're not headed back to that level. And so, in a dynamic where that's likely to be the case, a more normalization around monetary policy, I think fixed income markets can do just fine. It's just if I'm looking for pockets of opportunity, I'm probably looking elsewhere if that growth backdrop does start to reassert itself. So it's an important role to have in portfolios. It's an insurance policy, there's no question, but we think there are other areas of attractiveness.
Well, and talking about those other areas, we've had this entire market discussion without talking about, the breadth and depth of this market, where it has been a shallow pool when it comes to what's been driving things. Do we finally see a small cap rally, something along those lines? Do we see more breadth, or, there's a reason why the biggest things have been driving it and why they still look like they're going to keep driving?
Yeah, it's a great question. And when I think about breadth, I think about the bottom 493 in the S&P 500. I'm not thinking about small cap. And that's the unfortunate part about it. I think to some degree, maybe mid can have its day again, but we are not in an environment that's particularly conducive to small or mid cap exposures. The interest rate backdrop is challenging for smaller and mid-sized exposures on a relative basis. If the economic growth backdrop slows more than what we think, and we don't get that reassertion of growth and that reacceleration into 26, I think there's just going to continue to be a lot more pressure on mid and small. So we think, unfortunately, large and mega is the place to be, particularly in the US. It's hard to bet against the Magnificent Seven or even the top 10, however you want to think about that. But I think what's been interesting to see unfold this year is there's been more of a story around the bottom 493 participating than we've seen in the last few years. So that's my definition of market breadth, and that's what I think contributes to the sustainability of the rally that we've seen already and this slow grind higher. It's other components of the index participating going forward, but I don't expect to see that trickle down effect into mid and small. We might get a little bit of it, but I still think it's going to be a tough space for sure.
We've come this far and we haven't discussed the Fed other than a passing mention. But because you were talking about the importance of earnings and everything else, it's an earnings-driven market much more than it's been a Fed-driven market.
That's right. Yeah. I'll just say, for the better part of the last 4 years, the Fed's been in the driver's seat. Are they going to cut? How much are they going to cut? How long are we going to be at zero? When are they going to raise? How fast is it going to happen? I mean, it's like nothing else matters, right? Metallica again, nothing else mattered as it relates to the Fed being in the driver's seat. We came into this year actually thinking the Fed might finally be in the passenger seat. It was a key theme. And I think to some degree that was the case. It's also sort of funny to think about now that we thought the most important factor was going to be fiscal policy uncertainty. It feels like an understatement to say that, right? So I think from here, the Fed is still important. It's always going to be important. The market's always fixated on what the Fed is going to do. But whether they cut 25 basis points or not in September is almost irrelevant to the market. Why is that? Because financial conditions have continued to ease. So as long as the Fed continues to signal a bias towards policy accommodation, even if it stands pat, and I'm not convinced that they are. I mean, I think maybe the answer is just cut 25 and move on with our lives in September. But I don't. The market isn't that far off. There are times in economic and market cycles where the market's expectations for what the Fed is going to do or not do are completely insane. And that's a technical term for you. We're in different worlds. That's not where we are. We're actually very much aligned in terms of futures markets and the path forward. So that's good news, right? There's not this misstep that's likely to happen here if the Fed goes in a different direction, just stays on pause. But there's nothing to suggest in the data that the Fed's going to reverse course and raise. And that's the thing that's going to bug the market a lot. And that's an understatement. The market's going to really struggle with that, but we just don't see that as a viable path. So to the extent the Fed continues this, policy accommodation stance and a bias towards cutting, good enough. Market can focus on and worry about other things.
And you answered what would have been my last question without me asking it, which would be, what would be your nightmare scenario or what would totally change things? And obviously that answer would be rate hikes, which you do not expect. So we're not going to worry about them, but we will talk to you again down the line and see if that has held true. And meanwhile, rock on, Amanda. It's great having you on the show. I appreciate your time.
It's always fun spending time with you. Thank you so much.
That's Amanda Agati. She is Chief Investment Officer and primary rock star at PNC Asset Management Group. Learn more about her and the firm at pnc.com. And we'll come back, and before we put a bow on this show, we'll talk to you about all the rest of the interviews that are coming this week. So stick around because you want us to finish gift wrapping it as the finish line is in sight. We are back to put a bow on this show. Thank you so much for sticking with me all the way till the end. I hope you enjoyed that interview with Amanda Agati. Man, we've had some great interviews of late. I know it's summer doldrums. That's what it tells us about download numbers and everything else in terms of who's listening. But you're here, and hopefully you are feeling the benefit. And there's much more benefit to come because our lineup this week is killer. Michael Kelly, Portfolio Manager, Global Head of Multi-Asset at PineBridge Investments, will be here tomorrow. Mark Lucchini, Chief Investment Strategist for Janney Montgomery Scott, is here for the big interview on Wednesday. Eric Stein, Chief Investment Officer at Voya Investment Management, is here on Thursday. Plus, Jeff Mullenkamp from the Mullenkamp Fund is here this week, and more. There's a lot of things going on. There are some moving parts, and it's a little bit tricky because Gail has this week off. She has a bunch of vacation that she needs to use because she's worked for a very large, prestigious law firm in Boston for a very long time. And so she's got time she must use, so she's taking some of it now. Of course, we'll be taking more time when the baby is born. To my daughter, Whitney, that could be any day now. But Gail's taking some time off, so I'm working a light schedule this week. But we will still be here every day, and we will have shows for you. So please make sure you include us in your day. Speaking of things that you can include in your day, well, this is one I want everybody to celebrate. It's Annual Medical Checkup Day.
Is there a doctor in the house?
There is not probably a doctor in your house. And even if there is one, they probably are not giving you your checkup. My annual checkup is actually in just over 2 weeks. And if you haven't had one for a while, please do this. If you have had one, go back and ask the most important question.
What's up, Doc?
Yeah, that is the most important question. I do not know anyone who truly has a regret from having their medical checkup, their annual checkup regularly. I know plenty of people who have had regrets about things that they let wait. So please take care of that. It's also National Sons and Daughters Day, National Presidential Joke Day.
That reminds me of a little joke.
Yeah. Sadly, I can't tell a joke now because I'm struggling. The whole presidential thing, everything about the president could be considered a joke.
This isn't a joke, Chuck.
Oh, gosh. It's Play in the Sand Day, and especially if it's kinetic sand, because it's Global Kinetic Sand Day. But yeah, this week I'm sure I'm going to play in the sand a little bit because, again, Gil has time off, so we're going to spend a little bit of time at the beach, etc. On the food front, it is National Panini Day, and then raspberry desserts are big today because it is National Raspberry Bomb Day. And a bomb, it sounds like a bomb, but it's spelled with an extra E at the end. It's also National Raspberry Tart Day. And a bomb is different from a tart because a bomb is a frozen dessert that has layers of ice cream or sherbet, but like baked Alaska, that's an example. A bomb, it can have a sponge cake base. It can have a topping like meringue. And it's usually assembled, frozen into a mold that's shaped like a ball, specifically like a cannonball, which apparently is why it is a bomb. And I don't need to tell you what a tart is, because if you do not know what a tart is, then you have truly led a disadvantaged life. We were advantaged by our guests today. They were Ted Rossman, Senior Industry Analyst at Bankrate.com, which is exactly like it sounds, Bankrate.com. David Traynor is founder and president at New Constructs, newconstructs.com, and Amanda Agati is Chief Investment Officer at PNC Asset Management Group, online at pnc.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my puppy. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Richard Russell, who said, "A bull market tends to bail you out of all your mistakes. Conversely, bear markets make you pay for your mistakes." Well, we're not sure that you're going to have to pay for mistakes soon. We know that you want to make sure that you're not making mistakes, but keep everything in perspective, because mistakes are just experience in another wrap. And remember, until we do this again the next time, best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own own purposes, be they good or evil. You must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
This concludes the broadcast from World Control.